Hey everyone, in this video, I'm going to bring you 10 cheap stocks you can buy at forward price to earnings ratios less than 10. So I'm going to go through each of these 10 stocks relatively quickly. If you want more information on any of these stocks, I've got several videos on my channel about each of these 10 stocks. But to keep this video short, I'll go through them relatively quickly. So let's jump right in. Let's see what these 10 stocks are.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so I mentioned they're cheap based on the forward price to earnings ratio. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. So now that you understand why the price to earnings ratio is what makes a stock cheap or expensive, let's take a look at the 10 stocks, starting with Alibaba, the first one on the list. Alibaba is trading at a forward price to earnings of 7.364, and Alibaba's operating profit margin has been on the rise, going up to 14.28%. Of course, as with each of these 10 stocks, there's going to be a reason why the stocks are selling cheaply. Sometimes several reasons why they're selling cheaply. Otherwise, they wouldn't be so cheap, right? In the case of Alibaba, it's selling cheaply because the Chinese economy is recovering much slower than expected. The country's actually experiencing a bout of deflation when the rest of the world is experiencing inflation. And so that, along with geopolitical risks, has Alibaba stock trading cheaply. And in my opinion, it's a value for long-term investors. The next stock I'm going to mention is eBay, trading at a forward price to earnings of 8.858. eBay's operating profit margin is a healthy 20.84%. eBay operates an asset-light business model. It just brings together buyers and sellers, and it takes a fee for every transaction. That asset-light business model allows eBay to generate higher profit margins, higher cash flow from operations. However, the reason eBay is selling so cheaply is because the company is not growing rapidly, is growing very slowly. And so investors are not excited about eBay, which is losing market share to companies like Amazon, Shopify, and Etsy. The next stock I'm going to mention is AT&T, which is trading at a forward price to earnings of 6.678 and is generating an operating profit margin of 20%. AT&T is selling cheaply for the same reason why eBay is selling cheaply. AT&T is operating in a saturated market with very little growth expectations. And so for that reason, AT&T stock can be had for a cheap valuation, but I still think it makes a good investment for long-term investors. And you can't talk about AT&T without talking about Verizon, similarly trading at a forward price to earnings of 8.237 and also an operating profit margin of 22%. Verizon faces the same headwinds AT&T faces, operating in a saturated market very little growth expectations ahead. Still, the company generates strong profitability, has a sticky customer base, right? Who cancels their cell phone subscription? Very few people. Even if you lose your job, you're not going to cancel your cell phone plan. You might switch to another carrier, but you're not going to cancel altogether. More than 99% of customers renew, and for that reason, the company can continue generating strong profits for several years into the future. The next stock I'm going to mention is Altria Group, trading at a forward price to earnings of 7.8, generating a phenomenal 56% operating profit margin. And the reason Altria Group is selling cheaply is because governments worldwide are trying to crack down on smoking, trying to get people to switch to non-combustibles, and that's what Altria Group is doing, transitioning the business over to non-combustibles as cigarette smoking decreases worldwide. Still, the company generates excellent profitability on the existing sales while it transitions to a new form of business, and I think that makes an attractive investment longer term. And partnering with Altria Group is British American Tobacco, trading at a forward price to earnings of 6.492, and it's even more profitable than Altria Group at an operating profit margin of 61.6%. Only the second company that I'm aware of that generates an operating profit margin over 60%. The other one being Visa, which I also recommend as a top stock to buy, but it's not as cheap, and that's why I didn't include it in this video. But an operating profit margin of over 60% is in a league of its own. It's absolutely elite. And so, yes, you're not going to get very much growth with British American Tobacco, but you are going to get excellent profitability, and you're going to get the stock at a cheap valuation. The next one I'm going to talk about is Macy's, which is trading at a forward price to earnings ratio of 6.751. Its operating profit margin is relatively small at 4.16%. However, Macy's has an interesting investment opportunity in that its real estate is valued at more than the company's market capitalization. If Macy's can find a way to unlock the value in its real estate, it could do something like sell the real estate and then lease it back in those locations it wants to remain, or it can close down and sell those most profitable real estate locations. It can figure out a way to unlock that value in real estate, and that's what has me attracted to Macy stock. Macy stock is one that I own here in this group, and I think it can find a way to unlock that value. It's an attractive investment for long-term investors. The next one I want to mention is JD.com with the forward price to earnings of 6.461, an operating profit margin of 2.78%. And the reason JD.com is selling at such a cheap valuation is the same reason why Alibaba is selling at a cheap valuation, and that is concerns over the Chinese economy and geopolitical concerns, and that has JD.com selling at a cheap valuation. But I think those concerns are a little bit exaggerated, and I think investors have an opportunity here with both JD.com and Alibaba stock. The next one I'll mention is Ford Motor Company, trading at a forward price to earnings of 6.647. Its operating profit margin has been steadily rising up to 4.17%. The reason Ford Motor Company is selling at a cheap valuation is because it's not a hyped up EV stock, right? If you look at the EV only companies like Tesla, Lucid, Rivian, and others, they're selling at significantly more expensive valuations because there's so much enthusiasm around electric vehicles. Well, it's not like Ford is not selling electric vehicles either, but they're just doing it more prudently. They're saying, well, customer demand is not so strong for EVs right now, so we'll keep making these internal combustion engines, which are really profitable for us, and we'll slowly ramp up production in EVs. And if we need to, we'll speed up the production of EVs. But for now, customer demand is not that strong for EVs. So we'll focus more slowly increasing that while we generate our significant profits, billions in cash flow from our ICE legacy business. And in the meanwhile, we'll transition slower. And so that strategy, or the fact that it's not an EV exclusive company, has it trading at an attractive valuation. And I think investors looking for a cheap stock can add Ford Motor Company to their portfolios. In fact, investors looking to benefit from the rising EV trend, I think Ford is an excellent way to play that trend because you get to benefit from that at a cheap valuation versus all of the other much more expensive EV stocks. And finally, the last stock I'll mention is probably my favorite in the group. PayPal is actually in my list of top 24 stocks to buy in 2024. I'll link to that video at the end of this one. PayPal is selling at a forward price to earnings of 9.917, and it generated an operating profit margin of 16.47%. PayPal stock is selling cheaply for a couple of reasons. First, most notably, PayPal has lost millions of monthly active customers over the last few quarters, and that continuing streak is risky for investors who are concerned about competition for PayPal, wondering if it's relevant anymore. And that streak of continuous decline is only fueling more fears from investors. And so that's why PayPal is selling at this cheap valuation. However, in my opinion, I'm going to argue, and I've been arguing, that PayPal offers an excellent risk versus reward for long-term investors. I actually own PayPal stock as well. So there you have it, 10 cheap stocks you can buy now for 2024 and beyond. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.